BlackRock just out with quarterly results, and we have the man behind them, Chairman and CEO Larry Fink. He joins us now to talk about the numbers and much more. Good morning to you.
Good morning, everyone.
We got a lot to talk about. Before we announced the earnings, or you announced the earnings and we reported them, and during the tease, I had said more than $6 trillion. And now
it's just a shy.
And now the number has come under $6 trillion.
Yes.
Barely 5.98.
5.98.
Actually, today it's higher.
It is today. So, but just speak to what's happened in the market and what's happened in the marketplace, because clearly there have been outflows, not to the extent of some of your competitors.
Well, we had inflows. So we had inflows in the fourth quarter. We had $124 billion or $123 billion of inflows throughout the year. The industry had huge outflows. We had, I would say the year was a year of records, good and bad records. We had, which even surprised us, we had record inflows in ETFs and iShares in the fourth quarter. And we had $81 billion of inflows in the fourth quarter in ETFs.
How much of that, by the way, was in the last 2 weeks?
I don't remember the last 2 weeks, but it was, what I do remember, it was pretty spread out, and I could get into the composition of what happened there. And over the year, we had record inflows in our alternative space of $16 billion. And then in the center, that's where we had outflows. So you're seeing this hollowing out of the center. You're seeing the barbell of alternatives and index products becoming more and more dominant, and we're seeing that throughout the industry. We estimate the industry's mutual fund worldwide minus ETFs had outflows about $450 billion in 2018. And so, in addition, we had record revenue increases in our technology business, up 19%. So, where we saw the negative, we had about $90 billion of outflows in the index mutual funds, where people just take exposures. Now, that's a full year.
That's the low-fee stuff, too, right? It's
tiny.
Yeah.
Even with that, our institutional business had net new revenues. So even with those outflows, because of the composition and more alternatives, we had increases in fees in our institutional business.
That tells you the difference between the institutional and retail investor, or what does that show you?
Well, no, I would say across the board, and let's step back for a second. Investors have a real choice to pause, unlike the last 10 years. They can put money in a money market fund and earn close to 3%. That is another reason why we saw outflows in fixed income. You could be in a money market fund instead of having any duration.
Right. And you think that's changed the psychology
totally.
of the investor market class, right?
Absolutely. Because you are paid to pause. But overall, I think the biggest issue, as you discussed, Andrew, we had huge equity declines in the fourth quarter. We had commodity declines. We had about a 5% decay in our asset base, not because of outflows, just because the market fell.
Right.
And that's what you saw in our assets. I mean, we have benefited as a firm over the last 10 years with rising equity markets. We believe over the next 10 years, equity markets are going to be higher, but we are going to see those types of swings. Now, we all know the fourth quarter was a pretty severe downdraft in the equity markets, and that reflects in our NAV. But we had organic growth, unlike the majority of the industry, and we are. And let me just say one thing: what I think is really differentiating us, and also I think it's changing the whole composition of the markets. We're seeing in the wealth and the retail side, investors move away from stock picking, moving away from buying a product to working on models and really now portfolio composition. We all know, and all the academics will say 80%-ish, 70%, depending on the academic, of the performance is through asset allocation. Now, I'm not trying to suggest everybody knows how to do a proper asset allocation, but you're seeing less focus on an individual stock, less focus on a product, and we're seeing more of the wealth managers and their firms focusing on portfolio composition. And this is how we have been always talking about it at BlackRock. We've talked about we're a solution provider. We're working on that. We have many models for asset allocation. We have risk management tools. And so, we are benefiting by that change. And I think 2019, I think we're going to see some very large benefits by providing the risk technology. I think, we announced about Morgan Stanley. All our financial advisors are now on Aladdin for wealth management. We have more demand for that product
That's
than
your
almost
technology
any
platform,
product.
just so everybody's clear.
We announced last week that we are now using iShares as a technology with Royal Bank of Canada, now using the iShares platform for their own ETFs. So we're white labeling our ETFs. They're using our technology. It is going to say to their clients, RBC iShares. We have...
How much, do you have a big business doing that already?
This is the
first
beginning, but I believe it's going to be quite large.
And to do a white label branded service for a lot of
But
people.
also using our technology and then intersecting that, and it saves them a lot of money too.
But that's not just a brand licensing situation.
No, we are doing the
Right.
manufacturing for them.
Gotcha.
Similar to what we have done with, with other firms.
Speak to this because I know a number of your employees and other people on the street want to understand it. You did announce a layoff plan.
Yes. We did it already.
I know, but just explain what that's about.
Well, it's a painful moment for me. It's a painful moment for many people. We have grown in our headcount by 7% a year for 5 straight years. Not all of our businesses were performing at the levels, but most importantly, we needed to reorient the organization. We needed to have the capacity to invest in all the new areas that we see where we could invest. And we determined that the best way to do it is to re-footprint some of our areas in the world.
But this was mostly just across, wasn't it?
It was across the world.
It looked like it was an across the board.
It was. There was some concentration in some of the businesses where we believe, there's more to do. But from January 2018 to now, even after that, we're up 3% headcount growth. So it was just more of a reorientation that we thought we needed to do. We don't have a culture that weeds out 5% every year like some other firms do. So we don't have that. We believe that creates a negative culture. But unfortunately, sometimes we have to do this. This is probably the 3rd time in the last, 15, 20 years we've done something like this. So I don't enjoy it. I went home depressed. But it is what it is.
I'm going to ask you about bonds and stocks because,
Wow,
I think that you're obviously from your career, you're one of the greatest watchers of the bond market and interest rates and mortgages and everything else. But I think I give you a lot of credit for stock picking or just for the market as well. So I want to ask you about both markets, okay? Number one, what do you want to do first, bonds or stocks?
Whatever you want to do, Joe.
On December 24th,
yeah.
Did you get the feeling that were you at that point wondering, I think what we needed to convince most people was you can't just assume this is a garden variety correction. You better be ready to run for the hills, and that's the kind of feeling you need to make a bottom. Do you think we made that bottom on December 24th, or do you think that there's something on the horizon that means we'll go back and test those and maybe go lower? In your gut, what do you think?
I think in the short run, we probably hit a bottom.
That lasts how long?
Well, it really depends on what happens geopolitically.
Okay.
If you can give me an answer, where we are going with our trade negotiation with China, what is going to be the ultimate outcome of the UK?
Okay.
We also have a lot of noise around our shutdown.
Right.
And all of that just produces some uncertainty. And whether it's a CEO who's going to defer a purchase or that individual who's going to defer a purchase, you're seeing the seeds of a global slowdown.
Yeah. But
we have never believed we're seeing the seeds of a global recession.
Right.
Now, and I know there are people who believe that. We believe that the U.S. was going to contract anyway.
Yep.
The burst of the tax cuts, we're going to normalize. But now we have all this uncertainty, which is probably accelerating this normalization.
But sentiment-wise, do you think we wrung enough complacency out of the average person to where you could make a decent bottom? That's what I meant.
Well,
did you feel nervous at that point and say, whoa?
I think the pervasiveness of negativity would give you a...
Okay, let's go back. You know what we've talked about so many times, you worry about savers and retirement and everything else. So you wanted higher rates. Are you surprised that 2.5 or 2.75% bit that actually that started actually having an effect on the global economy? We're already. I mean, I would have thought we could go back to 4 or 5 before.
Well, we got up to like 320, and then we
on the 10-year. But on
right.
just, can you imagine? I mean, this is a new normal, if you will, a new normal.
I said this on this show. I think some of the changes which creates, I think, an accelerant. I think our cap on deductions is an accelerant because we know the blue states are already been hurt by this cap because of state and local taxes.
Yeah.
But as you start beginning to see rising mortgage rates, rising interest rates, that cap starts impacting even other parts, even in some red states where you have high property tax. And so I think there's different things that create probably more of an accelerant of slowing down than we've seen other times. Because I think you're right, Joe. It's hard to explain. We went up to 320 in the 10-year, and yet we had this global.
I mean, are you okay with the Fed stopping here, or one or two hikes after this? I mean,
I think the Fed talk right now is appropriate. Most Fed governors are talking about it's appropriate to pause. And I was surprised when they did their last tightening. I thought the language would be even more dovish, and I think that's what caused some of the problems.
It costs nothing to be dovish. Yeah, right.
And then this.
Well, it does when you have to raise it.
It does if you want to.
Well, raise it. Yeah,
but they said they were there may be 2 more tightenings. I was surprised at that statement. I think since then they have now changed the narrative.
Autopilot, that didn't help.
Yeah, I was surprised at that, and I think the market reaction was probably appropriate because I think we've seen enough, uncertainty in the world, whether it is China or what's going on in France and Germany and the UK, all the issues around the U.S. This is giving more and more people reasons to pause.
Larry, we know the fourth quarter, December in particular, was really chaotic. But what are you seeing in January? Are retail investors coming back in? Is this we know that the indexes have bounced back very sharply. Yeah. But what are you hearing from investors too?
We're seeing money being put to work. We have about $13 billion of inflows in our iShares platform month to date. Oh. We have seen pretty good flows. I don't want to annualize it, but we've had very good flows, pretty good flows institutionally coming back into the market. So we did see, we are seeing elevated inflows from what we saw institutionally in the fourth quarter. Hopefully that carries on. Hopefully our iShares flows carry on. So we are seeing money being put to work. And we'll see, but I would say more clients than ever before are asking questions. What should they be doing? Where should they be allocating the money? How should they be positioned? We had a huge downdraft in emerging markets. And then in the last few weeks, as the dollar started weakening, we started seeing new inflows back in. And we're still seeing that now, too. So, that's a carry on to Joe's question. Are we seeing more and more money being put to work? Do we believe now with the Federal Reserve slowing down their tightening, and maybe they're pausing for a long time, that would be an indication that the dollar is going to be on a path of weakening from its very large strengthening of last year. If that's the case, you are going to see elevated flows into emerging markets. That fear in emerging markets is going to be reduced. And with all the uncertainty about Europe, you may see more flows back in a more stable area, like some of the emerging markets. But until we have better certainty on trade and on China, I think, we're not going to see super elevated flows, but I do predict if there was a resolution between the U.S. and China related to trade, we would see a surge in investment sentiment.
Does it have to be a real resolution? Can it be something that they just say, okay, we agree to call off the dogs and we're not going to actually resolve some of these issues, or does it need?
I think if China reasserts its desire to purchase more U.S. products, and they set targets on what they're going to be purchasing, and they don't come to a resolution related to technology and intellectual capital, but they're working towards a resolution that will call off the dogs, and it just reduces the tension we don't believe China is going into a recession, but could we see a China going from a mid-6 growth rate to a low 5?
Negative? Oh, okay.
Yeah.
Right.
Yes. Is that bad? Not really. It's just, as Joe was framing his question, the negativity in the fourth quarter was so severe. So many hedge funds, as we now are saying, were offside.
Right.
And I think the biggest issue we saw in the fourth quarter was huge deleveraging from the hedge funds. It was a mini 2008 and 9. We didn't see large institutional clients sell tons of assets at any one period of time. And so I do believe that deleveraging has occurred. So we have built a base, a foundation for probably better two-way flow.
In such a fractured world, do you ever see a risk that sovereigns say, you know what, we actually don't want to use a BlackRock, or we don't want to use an American so-called company in this sort of grander trade war?
So I believe more and more companies are going to report consumer preference changes. I mean, we saw that with Apple's announcement. I think you're going to see more companies suggest that may be a reason for declines.
You see that in the financial world?
I've not seen that in the financial world. But Andrew, as you know, in my last year's CEO letter, I talk about having a purpose in every community. And I assert that you have to be, Mexican in Mexico, you got to be Japanese in Japan. I strongly believe, and I said this in my last year's letter, this anti-globalist views of the world now, this protectionism that we're seeing, is accelerating the need for every company to making sure where they operate, they prove their reason of operating, or they prove their purpose in the communities where they operate. I think that's going to be, that is a real key element for the success of any company today. So obviously when I talked about purpose last year, I talked about having purpose to your clients, to your employees, to other stakeholders, but I said communities and countries. And I think what you're seeing now in what we saw in 2018 and 19, you need to show that you are you're helping the community you're operating, whether it's Italy or China or wherever you are, or America.